everyone. Today I have with me Ralph Stewart, who is the Managing Director of Lifetime Retirement Income. Now, I'm sure many retirees will know lots about Lifetime Retirement Income, but for those who don't, Ralph, could you just give us a little bit of a rundown on who Lifetime Retirement Income is, and then we'll lead into talk about this brand new product that you're about to launch.
Great, Liz, and hi, and thank you for having us on your program. Quite simply, we're about helping people who are no longer working. So for the retirees of New Zealand, we try and help them, with whatever assets they may have. It might be their cash savings or their home or whatever, to generate a reliable and safe income that will last their lifetime. And pleased to say we started about 10 years ago, and today we're now managing over $1 billion for 16,000 people.
Right. And as we know, one of the big challenges for retirees is that quite often they are asset rich and cash poor. So providing that top up to income, it can be quite difficult for some people. So hence, we now have a brand new product called Lifetime Home. So perhaps you could tell us all about this new product and how it might help people.
Thank you, Liz. In our normal course of business, we help people stretch their pension pot, if you will, over 20 or 25 or 30 years to create an income. And we encountered a number of customers who said to us, listen, we don't have a pension pot. We have our home, we have NZ Super, and a small amount of savings. So is there any way we could use the assets that we have to generate an income for life, in the same way those do that have a large pension pot? So we had a look at different equity release options around the world and in New Zealand. And the most common option is what's called debt. In other words, people can borrow from a bank or a similar institution and use that money in their retirement years, but not repay it until they sell their house. And the cost to them is the compound interest of holding that loan for that time. Sensible, pragmatic, and workable. But we found for those people who just want an income, not a lump sum, in other words, drawing down a small amount through time, there might be better options. So we found in Europe, in France, in Germany, and England, a different model, which in French is called the voyageur, and that is where we buy a portion of your house as opposed to lending you some money on the security of your house. So we've introduced Lifetime Home in New Zealand, which has been 4 years in the making, which is our way of saying to retirees, if you'd like to sell a small portion of your house every year from 10 years for age 70, we'd be delighted to do that with you, and we'll share the ownership of the house. And at the end of the 10 years, you'll know exactly how much of the ownership of the house you have. Under the debt model, because the interest rate is variable, it's very hard to estimate how much of the home you'll own at the end. So one's a certain model, one's an uncertain model.
Right. So the debt model you're talking about is what people would know as a reverse mortgage. Is that correct?
Correct, Liz.
Yeah. Right. And so what you're proposing is something that has a similar sort of outcome, but doesn't involve debt, but still is able to use the equity in your home. So if you're in that situation where you have your home and not a lot else, you can, in effect, sell part of your home as opposed to taking on debt. Is that roughly how it works? And perhaps you could give us a little bit more detail on exactly how that would operate.
Correct, Liz. As opposed to lending you money at an interest rate and then you're repaying us when you sell your house, instead we do the reverse. So we buy a portion of your house, normally 3.5% of its value at the beginning, each year for 10 years. If the house was worth $1 million, we would pay you $25,000 a year, less fees and expenses for 10 years, or $250,000. And at the end of the 10 years, if you choose, entirely at your discretion, to sell the house, we then share in the value of the house based on its value at the end.
Right. So if you're taking a share in somebody's home, what does that mean in terms of the rights of the person who is selling you some of their home? Does this affect their ability to stay in their home for as long as they wish, for example?
Soundless, thank you. The agreement is that in this particular model, we will share up to 35% of your home over a 10-year period. After the end of the 10 years, it's your decision when you sell the home. That might be 20 or 30 years later. But if it was 30 years later, we'd still own 35% of the home. When the home is sold, you would receive 65 and we receive 35.
Mm-hmm. So how does this differ from a reverse mortgage? Does it have the same kind of effect, or are there advantages or disadvantages when compared to a reverse mortgage?
Yeah, great, Liz. I think you need to think about the purpose and the term and your age, because both have merits and both are models. If you want to borrow some money for a relatively short period of time for a lump sum for a certain event, a holiday or repairs to the home or so on and so forth, the reverse mortgage, is something you should consider carefully. If you want to generate an income from releasing a small amount of equity in your home every year for a longer period of time, that's probably a place for our non-debt model. So the two are quite complementary. It's really whether about you want a lump sum for a short period of time or an income for a longer period of time.
Mm. So in effect, you're offering people a different option for tapping into the wealth that they have tied up in their home. So as you say, that might be that in certain circumstances, the reverse mortgage is more preferential. So do you help people make that decision about what's the right model for them?
We do. We're not financial advisors. We can't do what you do, Liz. But we like to identify what the needs are of the potential customer, work through the best results, and show them examples of both a debt model and a non-debt model, and try and find the model that's best for the individual.
Right. And are there any particular circumstances where the lifetime home model works better than a reverse mortgage?
Yes. The problem with the reverse mortgage, which we've tried to solve, is it's uncertain. Because the homeowner doesn't know what interest they're going to pay, in other words, the rate changes, the ultimate amount of equity they have at the end when they finally sell their house is unknown. With the lifetime model, that is known. So, for example, at age 70, for 10 years, we guarantee the homeowner will own 65%. So the first space is, if you're worried about uncertainty and want certainty, the lifetime model gives you certainty. Secondly, it's because we're offering certainty. If you want income for a longer period of time, for example, 10 to 15 years, probably better than borrowing. If you want some money in the short run and are prepared to repay it fairly quickly, maybe within 5 to 7 years, borrowing might be a better option.
Right. Now, in addition to you taking some of the equity in a home, are there fees as well? Is there like an annual fee or an application fee?
Thank you, Liz. There is a series of fees. In the debt model, there's quite a few, and I'm not being disparaging, but they relate to your individual circumstances and are transaction related. With Lifetime, we've tried to consolidate the fees, and there's only 3. So when you first join us to consider your application, that'll cost 1/5 of 1%, or if it was $1 million, $2,000. Then every year we withdraw from your income payments $2,700. So from $25,000 a year on $1 million, we'll be paying you $22,700. So $2,300 in fees. And at the end, after the term has expired, after 10 years, we stop paying you income. We retain a 35% ownership of your home, and you stay in the home for as long as you like. But every year after 10 years, we ask you to pay us $1,000, which is indexed to help us value your home every year.
Right. Okay. And so are there any risks with this approach?
I think it's important at the outset. We require investors to get mandatory legal advice so they understand the agreement, understand what's going on. We need that before we can commence. We believe in financial advice deeply. So understanding which option is best for the customer is paramount. So shorter terms for a capital sum, probably debt's a better model. Medium to longer term for income, we might be a better model.
Right. And I presume there are financial advisors who will understand your new product I guess it's always a struggle, isn't it, with something new, is finding somebody who has the expertise. But, it sounds to me like you're able to give people a lot of information. How can people find out more about this product?
Thank you, Liz. Lifetimeincome.co.nz is our website. On there, you'll find directions to the debt-free equity release model. If you're happy to engage with us, we are delighted to work through and think through what is the best option for you. We'll make suggestions to you that we, again, suggest that you then pass those on to your legal advisor and financial advisor to help you make the right decision for yourselves.
Mm. And are there particular people that this product is aimed at? You've mentioned over 70, I think.
Yes.
People who don't have a lot of savings. So these are the kinds of people that should really inquire about your product to see if it's right for them.
Correct, Liz. We found a lot of our existing customers who joined us when they were in their late 60s and now in their mid to late 70s and have drawn down some of their capital, but are fit, healthy, and enjoying life and, active in their bucket list, have said, how can we use our home to further supplement the income we get from Lifetime, the income we get from NZ Super, to go for the next 10 years.
Right. So one of the criticisms we hear about reverse mortgages is that, that a lot of the value of your home is eaten up by those mortgages, and there's not enough left for the children or the beneficiaries of their estate. I mean, what do you say about that sort of thing? Is that something that people should be considering, what they are able to leave behind?
Thank you. The models are quite different. So if you think of certain and uncertain, so if we can make the assessment at the beginning that is correct for the customer, the journey should be fine. So if you go down the debt route, the interest rate's unknown. So how much capital or how much equity, I should say, you'll be left in your home is unknown. It will never be greater than 100%. So in other words, the bank can never take more than 100%. With the Lifetime model, as it's currently presented, if you're age 70 or older, we can never own more than 35%. So the difference is unknown versus known of 65%.
Right. So you know exactly what you're going to leave behind for your beneficiaries. But, I really think on balance that it's retirees have the right to use their wealth as they see fit to, for their own benefit first before they start worrying about leaving things behind to their beneficiaries. Would you agree with that?
Funnily enough, Liz, when we started out 10 years ago, we ran workshops around New Zealand, sort of what they call focus groups, talked to people about what was important to them. And one of the things that we thought was important was the ability to leave a legacy. And in our focus groups, we found the complete opposite. The complete opposite. We were 100% wrong.
Yeah. Yeah. I think, these days people's view is that their children can mostly take care of themselves, and they're doing pretty all right anyway. So I think, there are a lot of people moving into retirement who don't have a lot of savings for whatever reason. Perhaps they've lost their jobs, they've been through a divorce or redundancy, they might have had a mortgage right up until close to retirement. And for those people, it's a real struggle, isn't it, to try and live through retirement, which can be, 30 years long, without access to money. And, but it is important to have your own home still. That's my view anyway. I think it gives you certainty of your outgoings. You're not having to face, rent increases all the time if you were to choose to sell your home. So it's a much safer place to be in your own home, but you do need to have the extra cash somehow to top up your NZ Super. So this sounds like a really great product, one that is certainly well worth looking into to decide if it's right for you. And of course, as you say, it's always best to get some help from a financial advisor to decide whether it's good for your particular circumstances. Ralph, is there anything else you'd like to say in closing about this new product?
No, grateful for the opportunity to talk with you, Liz. Thank you. And as you call out, it's about creating as many options as we can to ensure that the retiree gets the right option for themselves.
Great. And if you could just give us that website again, thanks.
Thank you. lifetimeincome.co.nz.
Thanks very much indeed, Ralph.
Thank you, Liz.